welcome. You're watching another episode of All About Your Company. We're going to be talking about Antony Waste. Now, this is a theme where you're likely to see that as urbanization kicks in India, you'll start to see a pickup with regard to waste production and therefore a pickup with regard to a requirement in waste handling. This is a very unsexy business and therefore not too many players in it, but it's surely a business which can be driven only by scale. So only if you have that kind of scale and proven capability to manage, only then will you typically opt for a company which can handle waste, and therefore that becomes critical, having that experience and thereafter building scale on top of it. And Antony Waste is in an attempt to do exactly that. It's around 1,300 crore in terms of market capitalization. And in terms of what I want to know with regard to this company, one, what are the growth prospects? And why do I ask this question? Because when we've spoken to them in the past, they've suggested that a 25% growth tailwind could well be something that one can expect. But that's not come through. It's not, there's been obviously a lot of chatter. There's been a large addressable market, but we're not seeing the growth on the numbers of the company. So we'll try and understand that as probably the first piece. The second piece is with regard to receivables. Now, in terms of the quantum of receivables, it keeps going up. These are generally B2B contracts with municipalities, and therefore the payments are generally delayed. But managing it is what is crucial, and therefore cash flow isn't exactly the cleanest in this line of business. We'll try to understand whether Antony Waste is doing anything to address that problem or whether that's a systemic issue, and therefore that's something which we will have to build in as part of the business in case we are investing in it. The third piece is with regard to ROCE and ROE ratios. They've come off sharply with the kind of CAPEX that Antony Waste is doing. The opportunity size is large. They've also taken on debt. But that being said, you will want to likely see a pickup in ROCE, ROE at some point of time. Now, when is that? The timing of it and whether it can go above the 20% mark and stay there is the other question I'd want to understand. The fourth piece is with regard to CAPEX, and we spoke a little bit about that. They've won a 1,300 odd crore order from the BMC. It's a 10-year order, and they continuously keep winning orders like this. The question, therefore, is how much are they required to invest to kind of fulfill this particular order, which will give us a sense on future orders as well as to how CAPEX essentially plays out. The fifth piece is with regard to margin expectations. What to expect with regard to margins? They've been fairly stable, but they've guided for 23 to 25% margin while they're doing approximately 21% odd margins. So if there is a margin tailwind or not, a 200 bip margin expansion could well play out very well on that EBITDA CAGR, which we could get to see. And at what point do they hit that? And the last piece is with regard to a new vector of growth which could potentially come through, which is vehicle scrapping. How large is the opportunity? Again, what's the CAPEX like? How are they going to fund it? Because they have a decent amount of debt. So plenty of those parameters that we'll try and assess as we go through this show. Now let's talk about the company itself. We'll start off by understanding when it was established in 2000. It's a leader in the one of the leading players in the solid waste management space. They do mechanical sweeping of roads, for example. We would have seen that if you stay in Bombay or Delhi. And they also do waste to energy conversion. They are in the business of collecting as well as transportation of waste, as well as waste to energy, design, construction, operation and maintenance of the integrated waste management facilities that they have. One of them is sitting in Kanjurmarg in Mumbai. Now let's talk about how the business typically works. One is you will first bid for a contract, win a contract. Firstly, these contracts are not easy to win. Once you win the contract, of course, you'll do some bit of CAPEX. You'll purchase vehicles to ensure that you're undertaking the contract, and thereafter, that is what you will typically do. You'll do door-to-door collections. You'll transport and segregate. You'll also manage the landfills which are allocated to you. There's recycling and composting also, which will happen, and then there's waste to energy conversion, which is also an opportunity. In terms of the revenue split, you'll get a sense of how this plays out. 61% of the revenue is collection and transportation alone, 27% is processing, and 12% is other ancillaries as part of the contract. Now, in terms of the crucial piece, I'd want to understand where the margins are with regard to all these three, and whether processing as a percentage of the revenue is going up, because at some point we're going to have to process the kind of waste. We can't just be collecting, transporting, and dumping them in landfills. So how is that playing out is the other piece that I'd want to know. In terms of the business model itself, I did explain it, but some of the contracts are long-term contracts. They're around 7.5-year contracts, especially the collection and transportation side. The processing contracts are generally 20 to 25-year contracts. In fact, on average, it's around 23 years, the contract duration. So that gives you a sense on the kind of visibility you get, but also on the sense that you don't essentially look at order book for this kind of a business, because it can run into 20 years, that order book size. So the order book, which is currently sitting at around 13,000 crore odd, it can run into multiple years, and therefore it's not the right metric to look at when you are assessing a business like this. Very unlike defense, very unlike railways, generally order book is not the best metric. 10 states, those are just some of the geographies they operate in on your screen. And of course, the last piece is with regard to waste to energy and with regard to vehicle recycling or vehicle scrapping. All of that will also likely play out over the coming years, and we'll try and understand that. Now, in terms of the metrics itself, when you're looking at the top line, it's compounded at around a 13% CAGR over the last 3 years, from FY22 to FY25. Now, while this doesn't look particularly bad, but it's an industry which ought to be faster growing, because the need for this continues to go up at a dramatic pace, but the revenue hasn't kept pace with that. Also, there's a lot of room for growth for private players within this space, and Antony Waste is one of them. And therefore, while I've given it a thumbs up, given the 13% growth typically versus maybe another company, would be very happy to see this kind of growth. But the question therefore lies, the guidance is 25. Can they do 25? And at what point does that growth lever kick in? Really, that's the question. We've given this a thumbs up nonetheless. The EBITDA CAGR, as you can see, has just been 10%. So we've actually seen a shrink on the EBITDA margins as a result. And when you're looking at the net profit, in fact, the CAGR is just 4%. So higher depreciation costs, higher interest costs as a result of the debt they're taking on and the CAPEX they're doing is keeping a very heavy lid with regard to this number, which is the other piece you want to keep your eye out on. An unwind here could be a very quick unwind. In terms of the first half, it's a decent set of numbers. 14% EBITDA growth and 11% profit growth is what we've seen in H1. In terms of the operational efficiency or the margin trajectory that we generally term it as, it's hovered between the 17 to around 22-23% odd mark over the last 5 odd years. And what you're seeing currently is that margins are at around 21%. So that's what I mentioned. Last 2 to 3 years, margins have been around 20 to 21%. Guidance is 23 to 25. So we'll wait for that inflection point to likely come in. Let's talk about the balance sheet. But it's been stable, right? You've just seen a year or so where margins have dipped, and therefore that thumbs up. When you're looking at the balance sheet and you're looking at the book value, it's around 660 odd crore, but you look at the borrowing number, 473 crore. This excludes lease liabilities. So you've got a borrowing number which is quite high or weighs on the debt to equity overall. That's something you want to look at. Of course, some of it is short term, some of it is long term, but we've taken the cumulative borrowing number as we always do. It has around 100 crore of cash sitting on the balance sheet, so it has a decent amount of cash. Net of that, of course, borrowing maybe half time, if I can call it, debt to equity. But broadly, that borrowing number coming down is important, and we'll try and understand as to how they're going to do CAPEX by managing that. We're looking at cash flow of around 200 crore, which is fairly decent, fairly robust. But that is only for FY25. It's a 97% conversion rate. FY24 was 81% and FY23 was 61%. So in that sense, it's been choppy. Can they sustain the kind of cash flow conversion that they are achieving right now is the question, and we'll try and get an answer to that. For the moment, we've been cautious on this one. Return ratios, you'll see a steady decline, and I spoke about this a little bit with regard to the fresh capex that they're doing. The return ratios have fallen. Can they inch back upwards? And mind you, at their very best, it was at 20. It fell to 15 very quickly in FY23, FY24, it fell even further. 12% in FY25, looking unimpressive. But a lift, if it can happen quickly, will obviously be a positive. Let's look at shareholding pattern now. This is where some positivity can be built in. You've got shareholding of around 46% among promoters. It's a fairly steady shareholding, and therefore we've given this a thumbs up despite it being sub 50%. FIDI participation is frankly very small because the market cap of the company is very small, but 12% FIs, 4% DIs, 38% public. That's broadly the split. In terms of the number of shareholders as well, it's around 50 to 80,000 shareholders that they have. In terms of the valuations, the current price to earnings is 19 times. The 1 year forward, very few analysts track the counter, and hence we've not done an analyst recommendation, but just 17 times 1 year forward, broad brush, is what analyst estimates seem to be building in, which seem reasonable because a 10% to 20% odd growth is something that one can build in an industry like this. When you're looking at the 1 year range, it trades between 16 to 23 times price to earnings. The 5 year average is 14 times, which is quite low. In that sense, it's trading at the lower end of the range of the 1 year range, but the 5 year range is trading at a premium, and therefore we've given that a neutral rating as well. Now, let's go across. We have Mahendra Ananthula, who's the group, who's part of Antony Waste in terms of the management, and he's joining us this afternoon to give us a sense of all of that that we have to kind of break down in terms of Antony Waste. Let me first start off, Mahendra, by asking you, what's the growth CAGR that one can expect? Because it's an industry which requires you to grow fast. The opportunity size is large. I'm trying to get to why 13% over the last 3 years in terms of top line CAGR.
Good afternoon to you and all the viewers. Thank you very much for having me on your show. As you rightly said, that we always gave a guidance of about 22 to 25% CAGR growth and revenue. That is essentially because of the nature of the business. This business, essentially, when you win a contract, there is a gestation period of project implementation followed by O&M, which gives us a stable revenue. So it will never be a 25% year-on-year growth, but it will always be a function of what size of project we win in a particular year or a quarter. For example, in the last 2 quarters have been extremely good for us from the business, from a new order perspective. In the last 2 quarters, we bagged 3 projects worth 500 crores of revenue, some of which you mentioned in your commentary. The 2 Andhra projects the 2 Andhra waste to energy projects are 20-year BOT projects, which basically means that we have to incur the CAPEX, construct the plant over 2 years, and it will give us a stable revenue of over 20 years. Similarly, the Mumbai C&T contract, the collection and transportation contract, earlier we were doing only 1 package in Mumbai city. Now we have got 2 packages. So that also results in a revenue growth of 1,300 crore. So collection and transportation contracts, as opposed to a BOT waste to energy project, does not require very high degree of CAPEX. Okay, that's essentially vehicle finance, which is available at a cheaper cost. Okay, so those are typically, I would say, O&M contracts kind of thing with very limited investment. And the third project that we won is a Thane pre-processing project, which is EPC O&M contract, which basically means that we have to only take a short-term loan for completion of EPC works. Okay, and after that, it's going to have a 10-year O&M period. So as you see, I mean, these 3 projects itself give us about 5,000 crores of order book. And this will help us in growing faster and stick to our guidance of, I would say, 22 to 25% of revenue growth over the next 5 years.
Okay, so that revenue growth visibility becomes stronger, Mr. Mahendra. That's what I understand from you. Break this up for us. How much does Andhra contribute to top line, maybe over the next 2 to 3 years? And okay, give us also the timeline. And what's the kind of margin that waste to energy you get from the waste to energy project which you've put up? Let's unpack all that you've said. Let's focus on waste to energy first. Let's try and get a sense of how that plays out.
So the two other projects, as I mentioned, are BOT projects. So we have already signed the concession agreement and the power purchase agreement with the DISCOM. So we will be starting the construction in the next 1 month or so. So it will have 2 years of construction period in which we are supposed to implement the project. And after that, there will be 20 years of revenue by selling power to the DISCOM. The revenue from these two projects over next 20 years is about 3,200 crores. So you can say about 150 crore per annum uh, in terms of revenue during the O&M period.
Okay, and that kickstarts in year 3 from now, which I would assume
Absolutely.
would be FY29.
Absolutely. Yeah.
Okay, talk to us about the Mumbai win. It's a big win for you, of course. And how much does Mumbai contribute currently to your top line? And how much does this project, and how quickly does this project ramp up? Or rather, how quickly does this agreement or this order win start to kick through for you in terms of your top line number?
So as I mentioned, this is a collection and transportation contract over 7 years. Typically, collection and transportation contracts have 6 to 9 months of gestation period, during which one is supposed to uh, order for the vehicles, make the vehicles ready, and make the infrastructure available for kickstarting the project. So about 9 months from now, we will be getting revenue. We will be realizing revenue from these two projects.
And how much will the quantum of the revenue be?
Quantum of revenue is about 1800 by 7 is about 60 crores per annum.
Okay, so 60 crores per annum accrued straight from, uh, uh, you said it's
Sorry,
a
it
seven
is
and a half
60
year
crores.
contract. It'll
Yeah,
be
it's
much
a
more
seven.
than that.
It will be correct.
Correct.
Sorry, my bad. It is
It'll
185
be around
crore,
160
approximately
crore.
180, about 160,
Yeah,
170 crore
160 to
per.
180 crore.
Yeah,
Sure, sure,
both the
sure. So
projects put
that
together.
itself
Yeah,
should,
yeah,
so that itself should give you 15% of top line growth straight next year, which is 9 months from now.
absolutely.
Got it. And what are the margins typically on collection and transportation?
See, we don't give you segmental margin this thing,
Sure.
but typically construction this thing is on the lower side. The processing margin, EBITDA margins are higher, so the blended EBITDA margin is about 23 to 25%. That's the trend we have seen in the past, and we expect the same to continue in the future.
But you're doing 21 right now. What explains that, Mr. Mahindra?
So, see, there is also, I mean, we also have become wider over the years. We also have become
Right.
the importance of quoting right and making sure that, and the emphasis on receivables, cash flows, and so on. So we expect that it will go up, and especially with these new wins that we have, where the margins will be slightly higher than what we had been realizing in the last few years.
Waste to energy, how many players are doing this, Mr. Mahindra? Are you one of the few unique ones, or is this, are there plenty of players?
No, no. I mean, it's a very small universe. There is RE Sustainability, which goes by the name of Ramki Sustainability. So they have 3 projects. There is Jindal, which is doing few projects, and we are the third one. Yeah. So there are three, I would say, three main players in the waste to energy space.
Three main players there. With regard to vehicle scrapping, how quickly do you enter that? How much of capex requirement? Give us some nuances. And again, how are margins in that area?
As we had explained in the past, I mean, the vehicle scrapping is something as a concept. So for the time being, we are more focused on the waste to energy and the CNT contracts to kickstart. Uh, Vehicle scrapping is something that we still have in the anvil. The capex is not much because these are very modular structures, but we want to have our first project near Mumbai. We should be announcing more on. We should be announcing about that in the near future.
Why is it that you've guided for 20-25% growth in the past but not achieved it? How should viewers, how should investors look at you? Because if you haven't achieved it in the past, of course, there's better comfort, it seems, from all that you're saying. Going forward, at least for the next 2 to 3 years, there seems to be visibility of 20-25% growth. But what has stopped you in the past from achieving that?
So as I mentioned earlier, I mean, these are not going to be, it's not going to be a straight line. It's going to be a CAGR growth of 25 over 5 years period. So a few years ago, when we implemented the PCMC project, waste to energy project, uh, that gave us revenue from that, and then few more collection and transportation contracts, especially the Navi Mumbai one, which we started this financial year. So gradually, we expect to be in that range of 20 to 25 going forward.
Are collections a challenge or are they coming far better? Because FY25, when I'm looking at your EBITDA to cash flow conversion, it's far better. Is there something that's changed? Are you more comfortable with your conversion of EBITDA to cash flow going forward? Or is this a one-off and should we expect a lower number?
It's definitely not a one-off. I mean, there has been conscious decision to carefully select our clients. We also have become wiser over the years and so on. So that's why we are now bidding only for projects where we have better chances of timely payments from the clients. So that's why we are focusing on clients like the Bombay Municipal Corporation, Thane Municipal Corporation, PCMC. So these are the clients, who have paid us on time in the past, and we are looking at doing more and more business with similar kind of clients.
Okay. When it comes to your margins of 23 to 25, you're currently at 21. What gets you to 23-25%?
So, as I mentioned, that Navi Mumbai project, which we started this year, this should give us that should help us in increasing this margin. And also the waste to energy plant, which is now almost 2 years in operations, that also will help us in improving our margin. Because in the 2 years' time, we have stabilized the plant. We are witnessing PLF of close to 75%. So going forward, the next year we want to increase it to 80%. So all these combination of factors will help us in improving our EBITDA margin.
CAPEX, what is in the annual in terms of CAPEX? Where are you investing your money? You do 200 crore odd of free cash flow?
So the first and the foremost priority for us is to initiate our Andhra waste to energy projects. Because each of these projects will have a capex of about 325 crores. So that's where we will be using some of this money.
Okay, you take on debt as well because 300
Oh,
crore will be
absolutely.
steep.
Absolutely.
Yes.
Absolutely.
So where does your debt peak out?
We are already in the advanced stage of financial closure. So
Okay.
that also should be announced shortly. Yeah.
Got it. Where does your debt peak out, sir?
In about 1.5 years from now.
Okay, and at what number?
You mean the what debt rate?
Yes.
So that is something that we are still working out. Because
Okay.
we are hopefully next month we should have the financial closure for both these projects.
Okay. So when does your ROC start to get a lift? Once the CAPEX cycle turns, that's still a couple of years away, right? So does your ROC get a lift only thereafter?
No, not really, because it's going to be a gradual increase. As I mentioned, that the Thane pre-processing project is EPC O&M contract. Mumbai CNT doesn't have too much of capex, but the revenue realization and the margin is higher. So that will help us in gradually increasing the returns.
If I were to take a 3-year timeline, Mr. Mahindra, you're currently at nearly 1,000 crore of top line. Do you get to 2,000 3 years from now, say FY29?
Not 2000, but at least we should be touching close to 1500.
Close to 1,500. Okay, so when do you see that hockey stick kind of growth? Because you're saying it's chunky, right? So I'm trying to get a sense, when do you see that hockey stick growth of 25% CAGR?
As I
Do I look
mentioned,
at it over the 5-year tenure?
this is not the business. Infrastructure business is really the kind of business where you can have a hockey stick kind of growth. Projects that will help us in increasing our revenue, our bottom line. And as and when each of these projects are implemented, then we will have stable cash flows coming during the O&M phase. So it will be sort of a gradual growth over the years.
Okay, gradual growth, 1,500 crore in 3 years. Thank you so much, Mr. Mahendra, for coming in and speaking with us. This has been good. Viewers, just to kind of contextualize this, 1,500 crore in terms of top line over the next maybe 3 years down means that we won't, or we will unlikely see that 25% growth or 20-25% kind of growth kick through, at least in the near term. That's something which is slightly far away. So non-committal on that count. 21% is what they do in terms of current EBITDA margin. The goal is 23 to 25. We'll wait for that to come through as well. So some things still need to play out as part of the story, of course. But overall, looking positive with regard to the journey that he is looking at. And in terms of the CAPEX, of course, plenty to be looked out for. There's plenty of CAPEX in the pipeline. Again, something to look forward to. But with that, out of time on this edition of AAYC. We hope this was productive for you. Stay with us here on ET Now. More action on the other side.